I'm not here to give you a date for the collapse. I'm here to show you the legal architecture that already decided who pays for it. Most Americans still believe that if a bank fails, the government steps in with a bailout. You think Uncle Sam writes a check to save your deposits. That belief is not just wrong, it is legally outdated. After 2008, politicians promised they would never use taxpayer money to bail out banks again. They kept that promise. But they didn't make the banks safer. They just changed who pays when the system breaks. They moved from bailouts, taxpayers pay, to bail-ins, creditors pay. And here is the forensic detail your bank will never say out loud. When you deposit money, legally you are not storing it, you are lending it. You're not a depositor in the way you think, you are an unsecured creditor. Your deposit is not money in a vault with your name on it. It is a claim on a bank balance sheet. And under the resolution frameworks established after 2010, specifically Title II of the Dodd-Frank Act, unsecured creditors are not protected by sentiment. They are the buffer. They are the shock absorber. Today, we're going to audit that mechanism. I'm going to show you the specific FDIC planning framework that outlines how creditor claims can be satisfied with securities in a restructured bank. We will look at the math that proves the insurance fund is microscopic relative to the system, and we will look at the maturity wall hitting in 2026 and beyond that makes this relevant right now.
You might have heard rumors that the bank can take your money. Let's be precise about how this works in the United States, because the reality is more sophisticated and more dangerous than a simple theft. According to the FDIC's own resolution playbook, when a systemically important bank fails, they don't just liquidate it. They execute a single point of entry strategy. Here is the mechanism. The FDIC steps in and transfers the bank's functioning operations, the good assets, the critical infrastructure, into a new entity called a bridge financial company. This keeps the lights on, the ATMs work, payroll runs. From the outside, the system still looks normal. But the losses, the toxic assets, the hole in the balance sheet, that stays behind in the rotting carcass of the old structure, known as the receivership. And if you are an uninsured depositor, meaning you hold over $250,000, or you run a business with a payroll account, your money is not guaranteed. It is exposed to the capital structure. The FDIC's own April 2024 overview describes a process called a Securities-for-Claims Exchange. This is the part that sounds insane until you realize it's just accounting. They don't have to pay you back in cash. They can satisfy your claim with securities issued by the successor structure. You go to sleep thinking you have liquid cash. You wake up holding a claim that has been relabeled, restructured, and repriced to recapitalize the system. They don't call it confiscation. They call it a resolution. But the result is the same. You didn't choose to invest. You were pulled into the capital stack. And history shows what these forced conversions tend to look like. In Cyprus in 2013, this exact model was the testing ground. Uninsured depositors, those with over 100,000 euros, didn't lose everything, but they saw 47.5% of their deposits converted into equity. The bank was saved. The depositors became the buffer. That is the blueprint.
You might be thinking, this doesn't apply to me. I have FDIC insurance. Let's look at the balance sheet. This isn't an opinion, this is arithmetic. According to the FDIC's quarterly banking profile from late 2025, the Deposit Insurance Fund, the DIF, has a balance of approximately $150 billion. That sounds like a lot of money until you compare it to the scale of the system. Total deposits in U.S. commercial banks are approximately $18.6 trillion, so even a $150 billion fund is a tiny umbrella in a multi-trillion-dollar storm. If one mid-sized bank fails, the system can absorb it, but we are not facing a single bank failure. We are facing a systemic repricing of assets. According to research from the National Bureau of Economic Research, if interest rates remain remain elevated and commercial real estate distress materializes, the number of banks at risk of insolvency is not 5 or 10. It ranges from dozens to over 300 banks, depending on the severity of the stress scenario. And if multiple regional institutions fail at the same time, which is exactly what happens in credit cycles, that cushion gets pressured fast. In a systemic event, the law doesn't say, make everyone whole instantly. The law says, resolve the institutions, stabilize the functions, and allocate losses through the capital stack. Shareholders first, then unsecured creditors. That's not a theory, that's the resolution design.
Why is this relevant right now? Because the banking system is colliding with a commercial real estate maturity wall. Depending on the data set, trillions in CRE loans have to be refinanced across the 2024 to 2027 window, with major pressure points building into 2026 and 2027. These loans were written when interest rates were near zero. Now they must be refinanced at rates that have doubled or tripled. But the interest rate isn't even the biggest problem. The real problem is the death spiral of valuations. Office buildings that were valued at $100 million in 2021 are selling today for $40 or $50 million. And when a building sells at a 50% haircut, it sets the new mark for the entire market. That mark spreads. It forces repricing. And eventually, it forces recognition. Every bank holding similar loans has to confront the same reality. Their collateral is not worth what their balance sheet claims. Data from S&P Global shows this maturity wall peaking around 2027, which means we're not past it. We're in the acceleration phase. This creates a class of zombie banks, institutions that are technically impaired, but still open as long as nobody demands liquidity. But in a digital age, bank runs don't happen in days. They happen in minutes. And when confidence dies, the balance sheet doesn't negotiate. It collapses.
The system is designed to protect the system, not you. The Securities-for-Claims Exchange is the mechanism that can turn you from a saver into the recapitalization layer. So how do you opt out of being the unsecured creditor in someone else's failure? 1. Strict limits. Never keep more than the insured limit, $250,000, in any single institution. If you run payroll, hold escrow funds, or sit on cash from a business sale, you are operating inside the bail-in zone. Use cash management networks and multiple institutions to spread that risk. 2. Tier 1 assets. Own assets that are not someone else's liability. Physical gold and silver have no counterparty risk. If a bank fails, the metal in your safe doesn't turn into shares. It stays metal. 3. Treasuries. If you need liquidity, short-term UL treasuries, T-bills, are direct obligations of the government. They bypass the bank balance sheet entirely. The mechanism is in place. The maturity wall is here, and the math doesn't care about your politics. Don't wait for the bridge company to offer you securities you never asked for. Greed is good. Knowledge is better. Hog out.